Hello everyone. In continuation of the previous lecture, I will start today the types of the leverage and its implication. As I told you, there are the three types of leverage. First is operating leverage, second is financial leverage, and third is combined leverage. So here you can just see the concept of operating leverage. It refers to the use of fixed operating costs such as depreciation, insurance, repairs, maintenance, property taxes. These are the some fixed expenses which are fixed in nature, but it does not include the interest on debenture capital. Higher the proportion of fixed operating cost as compared to the variable cost, which is used for the production purpose, which fluctuates with the production, that is variable cost. Higher is the operating leverage. If the higher the fixed cost, the operating leverage will be high, and vice versa. So first of all, you should understand the concept of the operating expenses, fixed operating expenses. As I told you, some of the expenses which are fixed in nature, like depreciation, maintenance expenses, taxes, property taxes, and insurance premium, these are the expenses which are fixed in nature. And another concept is variable expense or the variable cost. Variable cost is that cost which fluctuates with the which changes with the production. If the output will increase, that variable cost will increase. If the output will decrease, the variable cost will decrease. Here, in operating leverage, we are just checking the effect or seeing the effect of fixed cost on the profitability of the company. The operating costs are categorized into three categories: variable cost, semi-variable cost, or fixed cost. Variable cost change for proportion to the production. Semi-variable, which some part of changes with the production and some is fixed. And the fixed cost, which doesn't change with the production, which is fixed in nature. Either the output will in less quantity or in high quantity, it doesn't change. Operating leverage. Here you can just see the formula of the operating leverage and the degree of operating leverage. Operating leverage, formula of operating leverage is contribution divided by EBIT, and degree of operating leverage is percentage change in EBIT divided by percentage change in sales. Degree of operating leverage, with the help of this, we are measuring the impact of the fixed cost, as I told you. In the next slide, we can just see how we can calculate the contribution and the EBIT. This statement of profitability indicates separately the operating and financial leverage. So before explaining this chart, I'll explain you the concept of the financial leverage, and then I'll come to you that statement. Financial leverage is primarily concerned with the financial activities which are involved in raising of funds through the different sources like equity, debentures, preference shares, bonds. With these sources, company can raise the fund. Whenever the company needs fund, the company can use these sources. If the company will increase the fixed charges bearing instrument, that is debenture, so you can just see the effect of that. The interest is again the fixed expense, and here you can just see the effect of that on the capital structure, on the profitability of the equity share. If the company will increase number of debentures in their capital structure, that will increase the interest as well as, and that how if the debenture will increase, the interest will increase, how it affects the profitability of the owners or the equity shareholders, and how it affects the earning per share of the company. Here, with the help of the financial leverage, we can just evaluate this. Degree of financial leverage measure the changes of operating profit or EBIT on the level of the earning per share. It helps in measuring the impact of interest cost. Either it is fixed, but it doesn't include in operating fixed expenses because it is not essential for it is not the part of the operating expenses. It is fixed in nature. So in financial leverage, we can evaluate, we can check the effect of interest cost. It is computed by the help of this formula, percentage change in EPS divided by percentage change in EBIT. And degree of financial leverage can be calculated by the EBIT divided by the EBT. The value of degree of financial leverage must be greater than 1. If the value of the degree of financial leverage is 1, then there will be no financial leverage. Now, come to the profitability statement. Here you can just see from the sales amount, if we will less or deduct the variable cost, we'll have the contribution. Out of the contribution, we will deduct the fixed cost. We'll have the earning before interest and tax. In formula, you have seen the EBIT. EBIT is what? EBIT is earning before interest and tax. Here you can see in this chart, earning before interest and tax. The abbreviation of this topic is the word is EBI. After deducting after deducting interest from the EBIT, you will have the profit before tax. And from the profit, you will just deduct the tax amount. You'll pay the tax out of the profit, and then you will have the net profit or profit after tax. After paying the tax, you will have if the company is having the preference dividend in their preference shares in their capital structure, then the company will pay the dividend on that also. And that is again the fixed in nature. So when the company will deduct or company will decrease the preference dividend from the net profit, then whatever the profit is left, that is the equity earning or that is the profit available for the equity shareholders. So in the first portion, till the fixed cost, you can see the operating leverage is operating leverage is the part of the first part, that is EBIT. And financial leverage helps in indicating the effect of the interest cost. Now operating leverage it helps in evaluating the fixed operating cost value. Now, the difference between the operating leverage and the financial leverage. Operating leverage is related to the firm's operating cost structure, while financial leverage is related to the firm's capital structure or the fixed bearing instrument. Operating leverage is helpful in measuring the business risk of the company, while the financial leverage it helps in measuring the financial risk of the company. Operating leverage is determined by the relationship between the sales revenue and the EBIT of the firm, while financial leverage is determined by the relationship between the EBIT and the EPS. So, in these slides, and this composite leverage or the combined leverage, it is a combination of both two, financial and operating leverage. In this leverage, we are calculating we are evaluating the overall value of the firm. And the formula of this is financial leverage multiplied by the operating leverage. In today's topic, I have taught you the concept of the operating leverage, in which the focus point is the operating expense, fixed expenses, which are depreciation, insurance, EMI, and the rent. These kind of expenses which are fixed in nature. We are just evaluating the fixed operating expenses effect on the profitability or on the EBIT of the company. And in financial leverage, we are just checking that we are evaluating the effect of increasing the number of debentures or the fixed bearing instruments in the capital structure of the company. Either this will help in increasing the profitability of the equity shareholders or not. If the company will increase the number of debentures in their capital structure, so is it positively affect the earning per share of the equity shareholders or the owner of the company? So these two leverages helps in determining the effect of the fixed bearing instruments or the fixed cost. In difference between operating leverage, here these are the 3 points where we have seen EBIT, the formulas are different of that. And operating leverage measure the business risks, but the financial leverage measure the financial risk. Now, operating leverage is related to the it focuses on the operating cost, and financial leverage focuses on the fixed bearing instruments in capital structure. That's all from my side. Thank you so much. In next slide, we will discuss the practical of the financial leverage. Thank